My name is Bryce Carter. I am the Chief Investment Officer. I'm a financial advisor with Financial Strategies Group.
Hi, my name is Mark Carter, Senior Financial Advisor with Financial Strategies Group. And I first want to say we wish all of our clients and friends the best of luck. Please stay healthy and be kind to others during these extraordinary times. The reason we wanted to do this live feed today is, as always, to keep our clients updated as we want you to know what we're doing here at FSG. 2 weeks ago, we put out an article with market updates. Last week, we repeated that with an updated article, and we will continue to do weekly updates as needed until markets settle down. We have been calling, emailing, texting, reaching out to many of our clients as possible to update them on their portfolio. We've rebalanced portfolios multiple times and will continue to do so as markets deem necessary. This volatility creates opportunity to upgrade our portfolio positions and to put our clients in the strongest position possible when the market rebounds.
Yeah, that's a great point. I think the big thing here for us is saying we're trying to be proactive. We're trying to be proactive with two things. One, what we're doing with your financial plans and your investment portfolio. But we're also trying to be proactive with our communication. So if you've missed any of those updates, they're available, fsgmichigan.com, go to Insight, go to blog, and if you haven't been getting those emails, just send us your email, we'll get you on the list. And one quick housekeeping item before we get going into the material here is that we are going to be closing our offices to non-essential business practices at the end of today. So we're going to have a few people in the office still, but we're trying to do our part and limit exposure and keep those at-risk individuals as safe as can be. That being said, we've set up for this for a long time. Ever since there was a terrible ice storm, I believe in 2014,
Right.
We made sure all our employees had the capability of doing their job at home. So we're prepared for this, and we don't expect any interruption in service.
Yeah, everything will continue. Phone lines will be answered, trading will be handled, compliance will be done. So business is normal, just remotely.
Thank you. So the anatomy of a market crash. So you've been working in the industry since the mid-late 80s, and you've seen a lot of corrections, but we've had a lot in the last 50 or 100 years. And if you think about some of the things that the market has endured and lived through, we're looking at the Great Depression, World War I, World War II, the Cuban Missile Crisis. I mean, how close were we to the end of the world during that situation? The Arab oil embargo, when there was lines for miles because gas stations were out of gas. Black Monday, which is probably the closest to what this has been as we've seen. The dot-com bubble and the housing and financial crisis. Do you want to maybe speak to how this feels the same yet different to those other scenarios?
Well, the scenarios, when you look at all those, the first thing you hear is people say, this is different. Markets are going to do different. We've never experienced this type of thing. Well, I've heard that through all these different events. All of them are caused by different reasonings. When you hear about Black Monday, the October of 1987, really what was going on right there, you had 22% loss in one day. And that's because there was no settling point for markets. So algorithms kicked in as markets were going down, trades were being sold, those stop losses were all kicked in, and it was this horrible snowball down. Well, we've stopped that today. You've seen the market be paused for 15 minutes. That was a correction from that particular scenario.
And it should be pointed that those circuit breakers, although it might be terrifying when you hear about it on the news, they worked.
That's it.
I mean,
that's the reason they were implemented. The other thing that's interesting about no matter how bad that Black Monday was in 1987, the markets finished up positive that year.
Yeah, so it's all a point of reference. And the part that we want to speak to specifically here is every time it's an emotional hurdle. It feels like this is it. Especially if you're retired and you're not actively contributing and you're living off those assets. We understand that, but we want you to know that the markets have a long history of tough times and recovering, and the good times outweigh the bad. And we'll get into some specifics on that in a minute. So that's where I wanted to speak to this, because we believe we're somewhere right around here. Markets may go down further, but people are definitely experiencing panic and capitulation. And unfortunately, I know there's people out there that are bailing on markets. I'm feeling sad for them because I believe that many will miss out on the upside.
Absolutely. This is the key right now. Emotion is your enemy. When it comes to markets, I don't care if it's fear or greed, it's your enemy. You're not making logical decisions because you're doing it emotionally. It's the same thing when you look at purchases. Geez, I want to buy that, and you do it based on emotion. You don't step back and say, really, do I need that type of thing? Same thing with relationships. If you act emotionally, logically, it's tend to work out a lot better than if you act on emotion. So try to eliminate the emotion. I know it's tough. I really do.
Well, and we're emotional beings, we're emotional creatures. 400 years ago, only 5% of the population was literate. In that world, fear is a good thing because it keeps you alive. In this world where we have to make logical financial decisions based on numbers and financial data, fear is not a good asset, right? It's not a good emotion to have, but we have it and we understand that.
It's all about not making a mistake because of the emotions.
Yeah. So where is the market? Now, the market peaked on February 19th, right around here. And since then, it's down about 30%. But currently, this is as of close of market yesterday, market's down 25%. Now, a 20% off of all-time highs is what's known as a bear market. And I'll talk more about that in a minute. But I guess maybe you want to talk about just the speed of which this has happened.
Yeah, so this percentage is not abnormal. We can go back in history and we can see this percentage many times. The problem is the speed is different, right? When you're really only talking about a month ago, right? A month ago we were at new highs, and here we are today. That speed is what's abnormal. And I really do believe a lot of that is motion and fear and different elements that we're facing. And of course the media exposed, we watch a lot of TV, you see it on social media, those type of things.
The speed of information is so much greater even than it was in 2008. And the speed in which trades happen, markets are just more volatile now because of the speed of information and capabilities of trading. But to put this in context, that looks really bad. That's a short snapshot. That's year to date, right? But to put that in context, you have to look at last year. And so 31.22% is what the S&P 500 did last year. This is a proxy for the S&P, so it's really close. But most investors didn't do 31%. And most investors aren't down 30% this year. But that's because the S&P was the best performer last year, and many investors are much more diversified than that.
Which they should be.
Small cap, mid cap stocks, international, and of course bonds. So as long as you've been in this business, last year was certainly one of the better years.
Yeah, I mean, it was a great year, and frankly, walking into 2020 in January, it really looked like the economic data, we were going to have a continuation of strong markets throughout this year. But it's a perfect example of why you cannot predict short-term markets.
Exactly. Now, to put that further into context, last year, this chart shows where the market has gone from March 9th of 2009 until close of business yesterday. So there's a couple things I want to point out on this. March of 2009 is when the last bear market ended.
Yes.
And this little gray portion right here, I hope you can see this okay on your screens. This little gray portion right here, that means we were still in a recession. So the market recovered before the economy said it's all clear, right? And so that's really pretty common over market correction cycles.
Yeah, a lot of times the market's working 5-6 months ahead of what the economy is. And that's a lot of the reason I think you saw the magnitude of decline so quick is they're really anticipating unemployment numbers to go up, the economic data and GDPs and stuff to not be good.
Well, and that's where we saw the market start to crash before our country was taking extraordinary measures, right? The market went down before we were closing schools and businesses. And I'm certainly optimistic that these extraordinary measures are going to stop, curtail this thing, flatten the curve, as we say, the country's been talking about. But what the point of this is to saying is that was a really bad crash in 08, 09, and it has been a long time since we've had a downturn. And so if you participated in those gains, we have to put the losses in context because they're really, and I know it's hard to see, but it's been a good run, and it will be a good run again. So is this normal? about once every 6 years we have a 20% downturn. It's been 11 years.
Yes.
2018 got close. But what I wanted to, Mark specifically to talk about is turnaround times and typically how long, because that's what people want to know.
Right.
How long do we
I mean, that's a common question we get. How long is this going to last? You listen to the media, you listen to those particular pieces, and people are talking about the extended time. All those are guesses, estimates, and different pieces. But what we can do is take a snapshot of history, and we start looking at this. When market goes down 5% or more, that's about 3 times a year, and the average recovers 46 days. If it goes down 10% or more, that happens about once a year. 117 days is the recovery time. 15% or more, once every 3 years, and the average recovery time is 275 days. When it's 20% or more, which happens about every 6 years, and again, it hasn't happened since 2009, but your recovery time is about 425 days, which frankly, we don't know that's going to happen exactly in this particular scenario. We're not trying to predict that. We want to show you what history did. But when you're looking at 465 days on these corrections as a history, yes, it becomes emotional, and yes, it is not what we want to see or you want to see.
That sounds like a long time.
It sounds like a long time,
Yeah.
but when you look at that in somebody's lifetime, so even if you're retired and you're drawing income and you need that income for your lifetime, that's a short period of time.
Yeah, many of our clients have 5, 8, 10 years worth of their income withdrawals in fixed bonds, fixed income, short-term securities, and cash. And so we can go a long time without having to sell stocks that are currently down.
Sell equities. Good point.
That's less than 2 years, and that's the average turnaround. And I'm certainly optimistic that the velocity of the downturn is equivalent to the velocity of the upturn this particular time. And so I think this chart just does a beautiful job of showing how much more dramatic bull market. So a bull market is when markets reach all-time highs and then eclipse those all-time highs. A bear market is a downturn of 20% or greater. And so the blue shows each bull market that we've had. And you can see how much longer and taller than they are than the shortness and the depth of the bear markets, right? And so even 2008 on here does not look all that long or all that dramatic, but that was a 1.3 year correction.
Yeah, if you think about the things that you were hearing again in that particular time with the media, you would have thought that this is a 20-year Great Depression, worst case scenario, the earth was going to open up and all of this was going to end. But in reality, you were dealing with 1.3 years.
Yeah. And so this shows, this is very similar to the previous chart in the context of what it shows. It shows the upturns and the downturns and how much longer bull markets are, up markets are, than bear markets, down markets. But these feel worse than these ones feel good, right? And so you want to talk about maybe the emotional aspect of that?
Well, I think it's, when we invest, we expect to make money.
Yeah.
And so when we do make money, oh, that's great. That's great. How much do we make? But when things go bad, it's more, I don't want to lose it. Look how much money I'm losing. Well, first of all, if we don't sell, we didn't lock in those losses.
Yeah.
Right? It's still about managing through those bear markets.
Exactly. And there's 2 points that I guess I want to make about the Great Recession and the Great Depression. Is one, Economics 101 says what you're supposed to do when you have an economic downturn is the government should spend more money and tax us less. That injects money into the economy. They did the opposite during the Great Depression, which is why it was so bad. They raised taxes and they didn't spend any extra money for 3 years. That made the Great Depression infamous because other than that, if that mistake hadn't happened, it could have been just another note on the history books, not a whole chapter. And then right now what we're doing, the government is spending money, they're injecting liquidity, and they're talking about helping the individual, which is, I think, probably needed for especially people that work in certain industries. So what to do and what not to do. I wanna frame this chart as this is logic and this is emotion. Now we're creatures of emotion, but we want to be creatures of logic during this time when it's easy to be emotional. So the first thing is a Roth conversion, and this is a great do right now. So on a traditional IRA, you're going to pay tax on every dollar that's in there. On a Roth IRA, you will not end up paying any taxes. And so when you convert an IRA to a Roth IRA, you're going to end up paying taxes now, but you don't have to pay taxes on those future gains.
Right, so this is a scenario where you can stay in the market, ultimately recoup on the gains, but all your gains from this point moving forward would be tax-free on the distribution side.
Yeah. Real quick reminder, if you have questions, type those into the live chat. We'll get those answered at the end. I have somebody keeping track of those questions, and we're going to try and answer those as many as we can. So tax loss harvesting, that is the act of selling an investment and buying another one just for the sole purpose of realizing that loss so that you can deduct it.
And we've been doing that, as many of our clients know, we've been actively doing that here over the past couple of weeks. We want to keep those losses in our back pocket. Now again, that doesn't mean we're exiting the market. What you're doing is you're taking a particular loss on a particular item and rebuying something else. It could be a similar, if we're trying to upgrade positions, well,
Yeah.
that'll help us not only for this year for taxes, but in years moving forward.
Yeah. Now, looking at refinancing, that's one of the upsides of this is interest rates are low, so it makes it cheaper to borrow. So looking at refinancing your home, if double check that rate and look into that.
Yeah, and if you're not sure about that, you don't have somebody that you can work with on that, let us know. We've got resources with other professionals, we can get you there, but it is a good time to, again, look at that if you've got a first or second mortgage or combining those, depending on your situation.
Exactly. Consider putting cash to work and increasing contributions. So if you're contributing to your 401k, one, you should keep doing that. And if you're able to, look at increasing it. That goes with the ultimate market holiest of rules in investing, and that is buy low and sell high. So if you're able to contribute more, that's a great thing. And then I want to say this one with a caveat, which is if you have cash that's been sitting on the sidelines and it works with your overall financial plan, which is why we'd want to have a conversation before you do it, it might be a good time to consider putting some cash to work.
Right, especially with the increased contributions, it's coming out of your paycheck. And again, if this scenario, this whole scenario has got it where you're obviously laid off or not working, that doesn't fit. But if you're working and you're making those contributions, we can bump them up now. We can always back them off later. If you're not sure, if you're looking at your 401k and say, I just been picking stuff, I have no clue what to do. Email us over a copy of your 401k, your 403b statement. We'll take a look for you. We'll give you allocation suggestions. We do that for our clients all the time and assist you there.
Yeah. Now, the don'ts, the emotional side of this. So don't bail on the market. And I'm just going to have you talk about it because I know during various different crashes, you probably had people that bailed.
Yeah, I mean, we've been pretty blessed. And even through this scenario, we've got more calls from our clients about doing the do's than the don'ts.
More, yeah.
Investing more, or stopping their withdrawals, or adding cash to portfolios. So we've been blessed, and all that's going to help them be in a better position when this all settles down. But in 2008, I'll tell you right now, I had two clients that I just could not do that, and to this day, they're both still clients. And we always have that discussion, and they're slapping themselves in the face.
Yeah.
We cannot tell you what to do with your money. That's not our job, and we're not going to do that.
We want to be empathetic, though. I can understand.
We do. We can understand, but we want to give you suggestions and advice that are going to help you ultimately.
Yeah. Don't fall victim to predators. So this is one that both of us can get red in the face on.
Oh, it's horrible.
I see it coming out of the woodwork already. People posting and the advertisements and the emails from wholesalers where these people are selling fixed products that lock you in for a period of years. And it might sound great now. Oh my gosh, I can stem the bleeding and get into a fixed guaranteed investment. But then you can't get out of that for years and years.
This makes me sick to my stomach. The same scenario happened in 2009. What happens here is you get these commission salesmen that are going out and they're basically playing on the fear. Okay? You could lose this, you could do this. Trying to talk people into selling at this particular point, locking in at a low interest rate for whatever duration, then there's no liquidity, you can't get to it, they're going to miss the upside, and it's all about somebody trying to make a commission. Make sure that you don't fall prey to that. as well as, if you go senior parents, etc. It comes out of the woodwork at this particular point. I think the good comes out of people, but there's unfortunately a percentage of people that the bad comes out.
Yeah, they're willing. There's many people out there willing to take advantage of the fear. Don't let that be you. Don't reduce contributions. So I understand right now there's situations where people have to take time off of work because schools are closed and things like that. And if it's part of your overall financial picture and you have to reduce contributions to your 401k or investment vehicles, I understand. But don't do it out of fear, because this is actually a good time to be contributing, not reducing those contributions.
Absolutely.
And then the last thing, do not watch the market news or look at your investment statements daily. It's unhealthy in a normal, regular upmarket environment, let alone this very volatile time we're in right now.
Let's face it, it will change your mood from a day-by-day basis. If markets are up, you feel better. If markets are down, you feel lousy, you're panicking, and you're doing all the wrong things, because all those things implement emotion.
Exactly.
Now, obviously, we want to keep you informed and we want to do these things, but if you're properly diversified, we're managing, again, through this volatility in this situation. Don't throw fuel on the fire.
Let us take that burden for you.
That's why you have us. Let us take that burden.
That's the first thing I do every morning is check the market futures.
That's our job.
Because that's my job. But I don't look at my personal investments every day. But I'm doing it. I'm looking at this data for you, not for me. When markets do recover, this is important to know. There's no all clear. There is not going to be a press conference saying it's safe to invest now. There's not going to be billboards going up saying it's safe to invest now. There's more likely to be billboards put out by predators than there is to say it's clear. The reason you should not bail, the main reason you should not bail on the markets is because you can't pick the perfect re-entry point. And that's the point here. In March of 2009, we were still in a recession. There were still question marks on the overall financial health of the country. But that would have been the best time in history to enter the market.
If you exit the market, you need a re-entry point if you're going to regain the dip that we've just had. And you will not time the bottom. Now, there's some ways that we can implement some dollar cost averages thing with new deposits. But, again, there's not going to be this sign. When everything is warm and fuzzy out there, the market is already going to be on its way back up.
Yeah. And that's where this chart, I think, shows this better than anything else. This orange line right here is dollars leaving the U.S. equity markets. It's investors reaching capitulation and bailing.
And this is March of 2009, right?
This is March of 2009. So March of 2009 that's when the market ended. And it's right around here, March 9th of 2009. And it went up from there. Finished the month higher. It was it. That was it. But record outflows in the month in which it all turned around.
More outflows than any time in history. And this was the bottom of the market, March 9th, and we had an 11-year run since then. And more people exit than entered.
17.32 billion left U.S. equity mutual funds in March of 2009. That's sad.
And also in March of 2009, that particular month, markets finished up positive.
Yeah, and that
was done.
It was it. And so this, I think, exemplifies that, and this is just taking this in context. So this light blue line is you were invested in January of 2007, you 100,000 invested, and you rode that wave. Now this is all in the market, but you rode that wave down, and you rode that wave back up. At the end of 2019, you'd have 300,000. Now, if you reached capitulation and bailed, and you got back in once you felt the market was all clear, it looks like the end of 2009, you would have about 195,000. You gave up a third of the gains, okay? And then if you left and never got back in, you had 57,000. So this just exemplifies you can't time the re-entry point. You have to a certain degree, ride the wave, and ideally your risk management strategy going into it insulated you from some of the most painful losses.
Right.
And that's where this comes in. This is a 60-40 portfolio, which for lack of a better, is kind of a rule of thumb retirement style type of portfolio, and 60% stocks and 40% bonds. And so what you'll see on this after most time periods, and you've lived through these, markets after 1, 3, and 5 years are usually up.
Yeah, and again, a lot of the things that we've been showing are dealing with the S&P and just 100% markets, right? Nobody should be 100% in one particular market. That's not good diversification to begin with. But when you look at these diversified portfolios, really what you're going to see is after 6 months, after 1 year, after 3 years, after 5 years, look at the numbers back up. It's phenomenal. Yeah. And so again, markets will bottom out and markets will recover. We just don't know exactly when, and nobody does because we don't know the extent of this. Yeah. But manage through it. That's our job, and that's what we're going to continue to do.
Exactly. And that's where risk management is key. So this orange line is U.S. government bonds. Now, for some of our more conservative portfolios and even moderate conservative, moderate growth, there is fixed income bonds, government bonds, and they tend to do really well during these times of periods of time, which is why we have them. So you'll see, U.S. government bonds via proxy, of GOVT, it's an ETF, is up 5.7%, and the S&P 500 down around 25% this year.
So this gives us an example when we were talking earlier about clients needing income right now,
yeah,
or our retired clients needing income. So when we manage these assets, we're not selling these particular pieces to generate your income. We want those equity positions, those dividends to be reinvested in a dollar cost averaging in. We've got resources in those moderate portfolios that have spiked, and that's what we will use to generate that monthly income. So that strategy is our sound strategy for the continuation of income distributions through retirement.
Yeah, and as Chief Investment Officer, this kind of falls under my purview, my watch, and some of the things that I do. So the way that our trading algorithms and trading systems work is we're often pulling income from the assets that are up, not the ones that are down. Because once you sell the down assets, they're not there to experience their inevitable rebound.
That's right.
And a couple of things that we've done for our portfolios, it varies. I don't want to get into too specifics because it really depends on your financial plan and so how we're developing that. But we have downside protection first portfolios where we've taken more precautious measures, and we have our growth with protection portfolios. And in those, we've made some positionings to where we want to buy things and have bought things that we think are going to do well on this rebound and tried to sell things that we believe are going to be lagging on this rebound. Right. For instance, a position trade we made last week, bought a fund that is overweight healthcare, it's overweight technology, which a lot of people are working from home and ordering things online right now. It's also overweight financials, which financials are very strong right now, and also overweight consumer staples, which is things that you and I need,
That's right.
Hamburgers and toilet paper, that kind of stuff. But we're going to go ahead now and start opening things up to questions. A couple questions I've gotten are around the Federal Reserve and how they're impacting markets and what they're doing and whether we think that's a good idea long term. So I'll say this, is I'm not a big fan of our country running huge deficits year after year after year. I'm just not. I believe that is a bad practice to do decade after decade. However, these are the times in which we should be spending money as a government to help the individuals, people that are being laid off, that are forced to stay at home. We should also be spending money on things like testing and things like that. This is when big government does play a role. However, there's been a lot of questions about industries, bailing out industries, and so I don't know if you want to talk about that some.
I believe that it's one thing when you hear the word bailout, right? If you look at the other aspects, when you start looking about loans to small businesses or to companies, if we look back in 2009 when the federal government loaned money to the auto industry, it was a loan. The federal government and the taxpayers, which are simply the taxpayers, got their money back plus interest, right? So when you look at this, there's multiple forms. This was not the airline's fault, the cruise industry's fault. It wasn't. Again, I think when we're looking at upgrading positions and doing the things that we do, we look at the balance sheet. How strong are these companies and what they're doing? But, nobody needs this country to go in more debt. But this is the reason our country is there to serve and protect, and falls under that. In
Certainly,
my opinion.
it's a rallying cry for all of us to band together and do our part, and the government has obviously a big role in that. The other questions I've gotten, I have gotten some questions around the individual checks they're talking about sending out, and whether as a capitalist believer, whether I believe in that or not. And here's the way I look at that, is every year you pay taxes, and in some years you get a refund.
Right.
I look at this as, at the time in which people might need it more than anything else, it's an extra refund.
It falls under the category of, I don't think any American out there has a problem with a helping hand. I have a problem with handouts sometimes, but I believe this is a helping hand. We have got people, obviously, in the food industry and other areas that are relying on temps. It's not their fault either that they can't go to work tomorrow. It's the safety issue. So I personally believe that we're here to obviously help as many people as we possibly can. So I view this differently.
Yeah, exactly. It's, you know what, it's you know, I hope I don't personally get a check. I don't need that right now. I hope it goes to somebody that needs it more than I do. But if I were to, it's just a return of tax dollars we've already paid.
Or it goes to a charity.
Yeah.
Right?
And so the other thing is I hope that during this time you're ordering from local restaurants. Pickup, you can get pickup. Tip well. I mean, these people are some of the most impacted. Take care of your friends that work in the healthcare industry. I know we have a lot of clients in that healthcare industry right now. Thank you for putting yourselves at risk for our sake. And let us know, certainly, if you need anything. It looks like I got a couple other questions coming in here, so we're going to try our best to answer as many of these as we can. Thank yous. I appreciate the thank yous. Okay, yeah, so this is just thank you on the article that we sent out. I hope we covered some of the data on that a little bit more clearly. Another question that I've gotten that maybe we can talk about is, I've gotten asked if markets could go to zero. So there's two instances of this, and I'm hesitant to even bring it up.
Yeah,
But I
it's
think
probably not a good idea. But not in the U.S.
Not in the U.S. So here's the thing, is that markets have gone to zero in two countries and two times in history that I know of. 1918, when the Bolshevik Revolution in Russia, when the Communist Party took over, they closed markets. And they did the same thing when the Communist Party took over in 1958 in China. So it's possible for an individual company to go to zero. But most investors are very well diversified with many individual companies in their
Hundreds, if not
funds.
thousands sometimes.
Exactly. Another question coming in here.
So realistically, for that to happen, all the companies would have to go under, and frankly, we all operate under the U.S. dollar, so the U.S. dollar has to become worthless.
Yes. Question from Brad coming in here. Should I look at purchasing stocks right now with most of them being so low? I think if you're young, you have a long time frame, and it works with your financial plan, right? Don't take the money that you need for groceries next week and buy stocks.
That's right.
But if you have extra cash set aside and saved for a time like this,
Yes.
you're never going to pick the low. So
Yeah, I mean, the other thing is we like implementing a dollar cost averaging strategy when it comes to this. What that simply means is, let's just pick a round number. You got $100,000 that you've been really looking to do something with, for example, where you might consider, doing 25,000 right now, and then gradually working your way in, because we're not sure, obviously, on a short-term basis where markets are going to go.
Yeah.
So working your way in with that cash is a better strategy than just throwing it all in at once.
yeah. Another question with regard to, we've talked about help for individuals, but we haven't really talked much about the help for industries and different companies. I know specifically there's a lot of questions around airlines and energy, which we didn't talk much about energy today. I will probably reference what's going on in the oil markets in my next market writing, probably around next Friday.
Right.
But do you want to talk about, I mean, we lived...
Well, we can talk a little bit about
Yeah.
the energy. I mean, part of the things that have also thrown fuel on this, as many of you know, is oil prices.
Pun intended. Feel on this.
So here you got Saudi Arabia, Russia, don't want to decrease their production. So we're sitting, I think we're $27 when I walked in this meeting, a barrel of oil. So what happens here, if we start looking at the U.S., especially the shale industry and these smaller producers, they need $55 or $60 a barrel to stay positive, to be able to actually produce oil and make money.
Yeah.
So if oil prices stay down this extended period of time, we're not really talking about ExxonMobil or BP and Chevron here, but there's a lot of small producers out there. And if they're too highly leveraged, which means they owe a lot of money,
Yeah.
and they're not able to generate, it's going to cause a problem. But again, when you start looking at these, we've had oil dips like this before, and they tend to rebound. I mean, I'm not convinced that we're going to see $2 a gallon gas for the next 6 or 8 months, right? We're here right now, but 6 months from now, just like I'm pretty confident 6 months from now, you're going to walk in the grocery store and there's actually going to be toilet paper on the shelf.
And so we're going to wrap up with this last one, but the B word, which is bailout of American companies. We've been down this road before in 2008, and I know that there were a lot of Americans very frustrated that their tax dollars did bail out companies, but specifically that it went to executive bonuses. Do you think
Yes.
we learned our lesson, and that that's going to happen?
Well, I will tell you that my frustration with that whole thing was there wasn't enough clauses in that whole
Strings
bailout,
attached.
strings attached to not make, frankly, greedy executives, and they're not all greedy, but a lot of them were basically rich out of this whole thing.
Yeah.
I have no problem. I don't like the word bailout. I prefer the word loan with conditions.
Fair term.
If you could do loans with conditions, things like there's a salary cap on all executives in that company until the loan is fully paid back. It's going to be paid back at this interest. Actually, the taxpayer and the federal government can make money on that, and it can be a win-win scenario.
Yeah. I don't think any of us prefer to see it. We'd rather see companies have strong enough financial position to
That's
not
right.
need any help. But there are some vital industries out there that they're vital to America's national defense and our long-term prosperity, like Boeing, which is looking at needing some help right now. I believe that we've learned our lesson from that. And so I think there's going to be strings attached.
Yep. Loans with conditions, not bailouts.
So that's going to wrap up our first ever Facebook Live market update memo. Please give us your feedback. If you like this, if you found it helpful, if you want us to keep doing these kind of things during particularly this time of stress, let us know. And also shoot us an email if you have questions that you didn't want to ask online. You can reach us online pretty easily, fsgmichigan.com. Thanks, and stay healthy.